Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio. The purpose of this video is to update you on the current trends of the business cycles. There's been some interesting changes, and what are the implications on the markets and on commodities and various sectors of the stock market. And of course, I would also give you an interesting relationship between interest rates and stock market that you will find very useful. Okay, here we go. My framework to look at the markets and whatever happens in the economy is the business cycle. That's where my focus is, and so far it's done a decent job for me. This is how things are working in my opinion. And phase one, business needs to replenish inventories. Business comes out of a very slow growth period. So demand is always there. So they need to replenish inventories. They have to hire people, hiring people, more income, more demand for the products. They have to produce more. So they have to borrow more, hiring more people, buy more commodities, and sort of a self-reinforcing process in phase one. When in phase two, the economy now is growing above what can do, and like any runner that runs too fast has to slow down. The forces that will cause the slowdown in the economy is rising commodities here, rising inflation, rising interest rates. At some point in here, demand slow down because consumers purchasing power is declining. Business is still producing because they don't want to give up the production. They filling up the plants, so they lower the cost of production. But at some point, they start losing money because inventories are too high. So they cut production. By cutting production, they cut the purchases of raw materials. They borrow less, so interest rates come down, and also they need fewer people, so there are layoff and unemployment rate increases. The economy here slides into some type of slowdown, recession. Doesn't really matter. What happens in phase four is the same. Commodities decline, inflation declines, interest rates decline, the stock market is weak. So there is a regrouping that ends at the end of phase four, when everything in equilibrium, business start producing again, and the cycle starts. So what I want to do next is let's see where we are, and let's see if the market behaves the way I think this business cycle says it should behave. This is how the business cycle looks in real life. This is computed from market data. When the business cycle declines, like in here, it means the economy is slowing down. And interesting enough, I show this in other videos and in articles that I wrote. The sectors that outperform the market are the defensive sectors. When the business cycle rises during this period, the cyclical sectors, the growth-based sectors, are stronger than the market. So what we're seeing here, beginning in the end to 2022-23, the business cycle started growing, and in fact, what we had is growth stocks have been outperforming. The interesting thing at this point is this curve had now reached a top. So what we are monitoring now is that if the curve goes down, then means that there is a change in strategy from growth sectors to defensive sectors. So let's see right now what the indicators are saying and the market is saying. This is the leading indicators of the conference board, and what it shows is that the economy is been improving because it's heading up, always rises when the end of a period of economic slowdown. So this is one gauge that says, look, think about growth, don't think about recession. This is a result of the survey of the purchasing managers, And by the way, this is S&P Global Survey, PMI. Different from ISM, is better because this sample is much bigger than the ISM. And what this survey is saying that the manufacturing has bottomed this at the same time as our business cycle indicator, and now manufacturing is growing. This is very important because when manufacturing is expanding, in order to produce, they need, as I said, raw materials, they need to borrow, and they need people. So this is the importance of that curve. And yes, the economy is expanding. Why? Because as shown by these two lines, income and spending are growing at 1.5, 1.7%, which is, by the way, the long-term growth of the economy. So all this data, again, are like to remind you, are consistent with our business cycle indicators saying the economy is strong. I mean, it's growing, not strong, is growing. So pay attention to it. This is a very important slide, by the way. It shows the money supply, which is green, and shows inflation. And by the way, this turning also coincides with the bottom of the stock market. So liquidity, financial liquidity is increasing. This is very important, very important. Why? Because the increase in liquidity leads by 1.5 years, roughly, turning points in inflation. It led it here at the bottom. It was leading in the peak in inflation. And now, after a year and a half, what you're beginning to see is inflation rising. So what we are having so far, what I said, is not only we're having an improving economy, but we have rising money supply, and also this will cause inflation to continue to rise. It's not likely to decline, according to my work. So we said the business cycle is strengthening, the money supply, liquidity, financial liquidity is increasing. So we should not be surprised to see rising commodities, energy, everything. Now, what about the stock market? Well, the relationship between the business cycle and the stock market, as I said before, is very precise. During this phase, when the business is expanding, which is the initial phase of the stock market, this is when growth stocks really shine. Okay, by growth stocks, cyclical stocks means industrials, commodity sensitive stocks, financials, industrials. But when the business cycle slows down, then there is a transition here that goes from aggressive cyclical into defensive. So you will see staples, real estate, and healthcare, dividend paying stocks outperforming the market. Right now, we are in this phase. I'm watching, obviously, very carefully what's going to happen next, because if it comes down, means that the investment strategy should move into a more defensive tone. And this is an example of the charts I like to follow. For instance, we know that the business cycle has been expanding, so we should not be surprised to see energy stocks rising. But what is more important is this curve that shows the relative strength of energy stocks relative to the S&P 500. So when this line declines, it means that XLE underperforms. But look what has been happening now with the economy strengthening. The relative strength has been rising, meaning that the energy sector is outperforming the market and will continue to outperform the market as long as this line increases, of course, and the prices rise. So this is the ideal combination to look for stock or sectors to see the price increasing, breaking above a previous top, like it happened with gold, by the way, and have relative strength increasing. So you're pretty assured that the breakup is going to occur and the trend is likely to continue up. Well, in a strong economy with a business cycle rising, the defensive sectors like utilities should underperform. And this is exactly what has been happening. The utility stocks, not only the price went down, but also the performance relative to the market has been declining. So the strength of the energy and other sectors and the weakness of the defensive sectors proves the point that the economy is still on an upswing and strengthening. So we are in a expansion phase. Uh, Interest rates, commodities have now been going up for a few months. There is plenty of liquidity. Income and spending is growing at 1.5%. So the rising interest rates, what will be the impact of rising interest rates on the stock market? Well, interest rates will continue to rise. We are here until they damage the growth of the stock market. Then the stock market at some point peak, and given the position of our business cycle indicator, we are closely to this transition here. Then the stock market will decline. And how far will go? Well, the stock market will decline as far as it takes to have an impact on the economy and cause interest rates to decline. Only then will the stock market go up again. So we have to go through the stock market peaks, the stock markets decline, interest rates decline, then there is the next bottom of the stock market. As I mentioned in the first slide, I'm the publisher and editor of the Peter Dack portfolio. You can find a sample here at www.peterdack.com. This is a book that McGraw-Hill Education asked me to write, and then I wrote two more books. And of course, I'm on YouTube with all my videos, which, by the way, I would really appreciate if you subscribe. Well, thank you very much for following my review, but the bottom line, as I told you, we are in a stronger economy, plenty of liquidity is growing, commodities, interest rates are rising. You see also spreads down very tight, so that proves that there is liquidity. So everything is okay until it's not. So the rise in short-term interest rates will continue until the market peaks and goes down. As I mentioned in the previous slide, that we follow that transition from rising to decline using our business cycle indicator, which is what the market is telling at the moment. Thank you very much for following. I hope to see you really, really soon. Take care of yourself and have a wonderful day.